Are we in a housing recession? What in the world's a housing recession? And does it affect the greater Chattanooga, Tennessee area real estate market? You know, for about a month or so, I've noticed a lot of chatter about a housing recession. Have you ever heard of the term housing recession? If you have, let me know in the comments below. Housing recession seems to be a new phrase, but it's become very popular, especially as we continue in this shifting, transitional real estate market. I first became aware of the term housing recession when Lawrence Yun, chief economist for the National Association of Realtors, or NAR, mentioned in the middle of August that we are in a housing recession. According to reports, Yun seems to think that a housing recession is 6 months or more of falling home sales. But it's not just falling home sales. In an August 18 NAR press release, Yun said, "We're witnessing a housing recession in terms of declining home sales and home building." So declining sales of existing homes and declining new construction. However, Yun continued, it's not a recession in home prices. Inventory remains tight and prices continue to rise nationally, with nearly 40% of homes still commanding the full list price. About the same time as Yun's announcement, the middle of August or so, we also heard from the National Association of Home Builders, and guess what? They're also saying that we're in a housing recession. Builder confidence fell for the 8th straight month in August as elevated interest rates, ongoing supply chain problems, and high home prices continue to exacerbate housing affordability challenges, the NAHB stated in a press release. The press release went on to say that the NAHB Wells Fargo Housing Market Index fell from 50 to 49 in August, the first time that has happened since May of 2020. Tighter monetary policy from the Federal Reserve and persistently elevated construction costs have brought on a housing recession, said NAHB chief economist Robert Dietz. Notice a pattern here? The Fed's shifting economic policies, including interest rate manipulation and open market operations, is the source of the current housing recession, however defined. So how is this housing recession impacting the market? Well, at the end of August, Forbes came out with an opinion piece taking what Yun had said about 6 months of declining home sales as the starting point. So that's the definition that the author is using in this article appearing April 31st. The author admits that two main forces driving the housing recession are increasing interest rates and increasing construction costs, which seems to be in line with what both economists Yun and Dietz were saying. But wait, there's more. What the author does is to take Yun's definition of a housing recession as gospel, then tie it into the four-stage real estate cycle or housing cycle: recovery, expansion, hypersupply, and recession. If you're a real estate investor, you're probably familiar with the concept. And what comes after a recession, at least according to the traditional real estate market cycle? Recovery. But not so fast. In July, an article appearing in Insider suggested that we had skipped one of the four phases, specifically the hypersupply phase, and that we were heading directly into the recessionary phase of the housing market cycle from the expansion phase. Todd Metcalf, the senior economist at Moody's Analytics, told Insider that the nation's lack of available housing inventory is throwing the entire cycle for a loop. Let that sink in. There's something different about what's going on in the current real estate market. In the typical narrative, the hypersupply is because construction companies overbuild and there becomes a glut of housing units, Metcalf said. This occurred during the housing bubble preceding the Great Recession. However, at the national level, we still see a severe housing shortage. But if that's the case, why are active listings continuing to go up in many areas in the country? And why do we have so many unsold new construction units reaching a level that we haven't seen since, I don't know, the 2008-2009 market crash? But Metcalf proposes an interesting alternative. Instead of the hypersupply phase, Metcalf believes that we're entering a demand exhaustion phase, where home prices don't fall due to surplus inventory, but decline as buyers' ability to afford them wanes. Demand exhaustion. That's it. What's to blame? Rising home prices and rising interest rates, to be sure, but to that we could add inflation, which has touched practically everything you and I try to buy today. In short, home buyer demand has deflated due to the economy. Fortune Builders has a great explanation of the four phases of the real estate cycle. Know what they say about phase 3, hypersupply. Inevitably, there will come a tipping point at which supply begins to exceed demand, either from too much inventory on the market or because of a sudden shift in the economy through which demand pulls back. Now, which do you think has occurred? Clearly, demand has pulled back because of rising home prices and rising construction costs, as well as rising interest rates and inflation, tying into what Yun and Dietz said, plus what you and I have experienced every time we go to the grocery store. So it seems that we are in a phase that still has aspects of hypersupply due to the pullback in demand. But does our shifting or transitional market have aspects of a recession phase as well? Note what Fortune Builders says about the recession phase. During the recession phase, supply exceeds demand by a wide margin, and property owners, this would be landlords, suffer from high vacancy rates. But we're not seeing that. We're not yet seeing demand exceed supply by a wide margin margin, we're seeing suppressed demand chiefly due to rising interest rates and rising home prices, and the rental vacancy rate is lower than the long-term average. Even though interest rates have been going up, even though builder sentiment has been going down, even though the month's supply of new construction has been rising, and correspondingly, even though builders are now offering incentives to purchasing new construction, even though inflationary pressures are affecting everything, even though now home sellers are offering seller concessions, which they wouldn't even consider a few months ago, it does not yet appear that we're in a full-blown housing recession, at least according to the definition provided by Fortune Builders. Inman, a publication for the real estate industry, reported in late August that economists don't even know what housing recession means. We're experiencing a shifting market, a real estate market downturn, a housing transition, if you will, but there's no standard definition of housing recession, at least according to Inman. Quoting our friend Dr. Yun, Inman reports Yun saying that a housing recession is comprised of fewer home sales, lower housing starts, and declining mortgage lending, especially in mortgage refinance. Muddying the waters even further is Zillow chief economist Jeff Tucker's admission that a housing recession is a bit of a terminological innovation, describing a slowdown in economic activity in the housing sector that is sort of broad-based and deep enough to register and lasting more than a few months. Thank goodness the article's author comes to the rescue. A working definition for a housing recession, they say, may be a downturn that's measurable by multiple metrics, the starts, lending, and sales that Yun pointed to, among other things, and which is both deep and at least long-lasting. It's a downturn, but more pronounced. In other words, a shift or transition in the market due to demand exhaustion. Got it. What about the greater Chattanooga, Tennessee area real estate market? If we take Yun's earlier definition that a housing recession is 6 months or more in declining sales, then we're not there yet. In fact, while the official August data has not yet been released, looking into the back end of our multiple listing service, I can tell you that, at most, we've only had 2 months of declining sales in the greater Chattanooga, Tennessee area, namely July and August. We should also note that home sales, following the typical seasonal cycle, tend to decline naturally, let's say, during the fall and winter months. If the official August figure is similar to what I've presented here, we cannot say that the greater Chattanooga, Tennessee area is in a housing recession like some areas of the country, at least based on closed sales. Again, August report will be out in about a week. Further, if the final August 2022 number confirms the above, it would take another 4 months of declining sales, which means that we would already be in 2023 before we could say that the greater Chattanooga, Tennessee area is in a housing recession, at least according to Yun's initial definition of the term. And while I'm hearing from both agents and mortgage lenders that local sellers are reducing their prices, something that you're already familiar with because you watch this channel, and that sellers are offering seller concessions, those price decreases should be seen as aspects of the market leveling off, as sellers' price expectations become more aligned with the shifting or transitional real estate market we're in now. In other words, as sellers realize that they can't get the prices that homes were going for even earlier this year, they can either lower the price while the home is still in the market, or they can lower the price through seller concessions during contract negotiations. Either way, the price is coming down. But seller concessions, which is a novel experience for brand new agents and brand new mortgage lenders, are not signs that the greater Chattanooga, Tennessee area is now in a buyer's market, or even that the greater Chattanooga, Tennessee area has entered into a neutral market. No, seller concessions like list price reductions are indication that listing prices were too high. Just what kind of real estate market do we have now in the greater Chattanooga, Tennessee area? If this chart is any guide, and I know that other charts have different numbers of months, but if this guide is of value, Chattanooga is still in a seller's market, but is moving into a balanced market. Take a look. We can see that month supply, that is, how long it would take for all houses to be sold if everything sold, has been rising since April. Again, from the back end of the MLS, August days on market should be about 1.9, but that's still less than 3 months, which means that we're still in a seller's market. We'll continue to see more realistic home prices as homes are put on the market and as local sellers and their agents price homes more closely attuned to comp sales. And we'll also continue to see buyers do two things. First, buyers will ask not only for seller concessions, such as the seller contributing towards closing costs. Second, buyers will continue making offers less than asking price on properties that have been on the market 2 weeks or longer, and they'll do this at least as we head into the new year. Thinking about buying or selling a home in the greater Chattanooga, Tennessee area? Watch these videos next.